Well, joining me for more is Kyle Rodder from Capital.com. Great to see you, Kyle. So we've just seen an election outcome in Germany. The euro has opened higher in Asian trade. Now, this is an economy that has really gone from a powerhouse to a bit of a poorhouse in the last 10 years. What could we expect going forward?
Well, I mean, yeah, like you noted, we've seen the euro move higher at the outset. Only a modest move because this was largely in line with expectations, and it was really kind of, I guess, a condemnation of the Social Democrat Party in the way that it's sort of handled probably economic management over the last few years, especially when it comes to energy policy and some of the weak industrial activity that we've seen prevail over the last few years, and the recessionary conditions that have prevailed, but also maybe some of the foreign policy issues that have confronted Germany as well, especially as it's handled things like migration, which remains a very significant issue in Germany as well as the rest of the Euro bloc, and of course the conflict in the east of Europe. So, I mean, we're going to wait for a couple of months now before a coalition can be built, because it was a 29% vote in favour of the Conservatives. The Conservatives have already said that they won't build a coalition with the AfD, but the AfD now looks like it will be a major opposition party in the German parliament now, effectively raising these kind of Eurosceptic forces in Germany, which should, raise fears going forward, perhaps of, the stability of the German economy and also stability of the European Union more broadly. But overall, the movements in the markets have been fairly modest, really on the basis that this was expected. And there's a wait and see element to proceedings now, because again, there's going to be some, wheeling and dealing done for the government now to be able to form a coalition and then obviously get on with the business of governing.
Over the weekend, we saw Treasurer Jim Chalmers fly to the US. He is hoping to meet with the Trump administration over their tariff plans. Clearly, he is a little worried. So what are we going to see locally in terms of investor sentiment, I guess, ahead of those plans being cemented?
Well, it's an interesting development because over the last few days, and this was independent of obviously Chalmers' decision to travel to the United States to talk trade, is that we've heard reports that the United States is trying to strong-arm Mexico into applying tariffs on China's economy, more or less in as a means of trying to, or I should say, sorry, add tariffs on China's economy in order to avoid tariffs applied on the Mexican economy by the United States. So there is this, clear concern that maybe Australia could be caught more or less in the same bind, where the United States asks us to apply tariffs on Chinese goods in return for some concessions potentially on our own exports. Of course, this happening in the context of the recent tariff announcement on steel and aluminium, and of course fears that there might be universal tariffs applied at some point in time on global trading partners in the United States, which Australia could get caught up in. There's not really at the moment a major concern in Australia, I think, broadly speaking, about the economic impacts and the inflationary impacts of tariffs on Australia, just because there is that notion that the Australian economy is in a trade surplus with the United States that might help us navigate this storm a little bit and also negotiate perhaps more favourable trading terms. But, the big impact for Australia is effectively that if we start to see this tit-for-tat dynamic emerging, where, the US is using its power with its allies and its trading partners more or less to increase tariffs on its other trading partners, that could really inflame these global inflationary pressures from tariffs, and then also exacerbate the economic weakness that comes often from a significant supply shock, like a rapid increase in tariffs and this kind of race to the bottom dynamic emerging. So, I don't think the markets will necessarily respond too much on the basis of these talks, just because nothing is likely to get resolved at this particular meeting. Maybe we'll see some kind of carve out for those aluminium and steel tariffs. But again, this is a concern because the refrain over the last few months is that, Trump is really only using these things as a negotiating tactic rather than, a real bid to strike up the sort of global trading order too much. Again, it would seem that, the actions over the last few days point to the latter dynamic emerging, which is not good for the global economy. It's one of the reasons why we saw the market sell off on Friday night, because of, that data expressing that this is causing uncertainty in US businesses and for US consumers. So a concerning development, and obviously in Australia, the hope is that maybe we can carve carve out some concessions, leverage our strategic importance to the United States, as well as the fact that we've got that trade surplus with it to be able to at least avoid some of the worst of Trump's tariffs.
So last week we saw the Aussie climbing a little higher. What could we expect with the CPI data due out this week, and how that could impact currencies as well?
Well, the headline number is looking like it's going to pick up to 2.6%. We don't get a forecast for the trend mean figure, which is obviously going to be the significant one. Clearly what the markets took from the RBA meeting last week was that cautious tone that came through regarding future rate cuts, which, for me makes a lot of sense. I think the RBA is going to just respond to the official CPI data as it's released on a quarterly basis to decide whether it continues to cut interest rates, which effectively means the next live meeting won't be until May. But these monthly indicator releases will be fairly significant because it'll give us a little bit of a sense as to whether the inflation rate is tracking the trajectory that we were expecting for inflation, and whether that key print that we will get in April for the quarterly number for the March quarter is basically below 3% or not, or tracking towards below 3% or not, which at this stage we're probably going to need to see in order to get another rate cut. Of course, the counterpoint to this is that we're still seeing fairly robust labour market activity, despite the fact that, obviously the growth outlook or the growth conditions in Australia is are fairly weak, although those wage figures that we got last week suggest that there's, clearly very little wage price dynamics really contributing to sort of an upward push on inflation at the moment. The labour market is tight, but clearly not tight enough to deliver some of those wage rises. So we're really just looking at this data to see if we can get a good indication that the CPI, the trend mean CPI, is continuing to sort of trend lower and below that 3% level, and whether it will set us up for, the expectation that the next official CPI print at in April will be effectively within the RBA's target band.
And what else could we be expecting this week on the calendar?
It's that US PCE index that will be probably the most important thing, as well as those Nvidia results towards the end of the week on the 26th. So, a major event from the equity market from the, fundamental micro level. Chip demand remains a significant driver of US economic activity. This is also going to be something important because Nvidia is going to colour what the DeepSeek developments in China might mean for chip demand going forward as well as demand from those hyperscalers, which is sort of, looking as though it might remain robust. Meta, for example, is a great example of a company that looks like it's continuing to deliver on its AI promises and will continue to require a high level of chips to be able to, continue this massive capex that it expects going forward. So that's going to be a massive number, because we have seen Nvidia kind of recover, other than Friday night, from that kind of sell-off related to DeepSeek a few weeks ago. And then it's that PCE index that's going to be very important, because although it's not going to capture some of the pressures coming through from a higher inflation expectations, which we did see coming through in the University of Michigan final survey on Friday night, or certainly some of the elements of the recent CPI figure and the PPI figure that might lead to sort of perhaps some signs of stickiness in the core PCE print. Ultimately the markets are kind of concerned that because of what has been up until recently, and notwithstanding those services, that sort of concerning services PMI number that we got on Friday night, that's suggesting that because of this uncertainty relating to tariffs, the US economy might be rolling over into a bit of a weak patch. More or less, there remains these fears that inflation is sticky, that it's not coming down quick enough, that it might even be anchored in terms of core PCE in sort of the mid to high twos, and that the prospects of rate cuts going forward from the US Federal Reserve might be diminished, or at least deferred even further on the basis of that. So a very kind of heavy week, a backloaded week when it comes to data, but that Nvidia number will be huge for the earnings outlook and what it says about Mag 7 stocks and chip activity across the world, chip demand. And then when it comes to basically risk-free rates and how we value things, that PCE index is going to be so important for Fed expectations.